So the second section of your banking notes is going to discuss the Federal Reserve System. We'd like to be able to have a better understanding of how do the actions of the Federal Reserve impact our economy. Well, this is a great picture of some history that we have here in St. Louis as well as nationally. Here we have our Board of Governors office that is based out of Washington, D.C. Over here is the St. Louis Federal Reserve Bank that is downtown St. Louis. Here, Janet Yellen is our current president of the Board of Governors, and she's the first female that sits on the Board of Governors for the St. Louis Federal Reserve. And here is the money that the Federal Reserve makes available to banking systems. It doesn't print money, it makes it available. So the Fed has a structure. It has a 7-member Board of Governors who set the monetary policy. Those Board of Governors are nominated by the President and approved through our Congress. We also have a 12-member Federal Open Market Committee, also known as your FOMC, who sets the federal funds rate to be charged by Federal Reserve banks for money in which is borrowed from one another, as well as money that is borrowed from the Federal Reserve. And all board members sit on the FOMC. And in addition to the board members, the 7 board members, there's 5 members of our 12 regional member banks that are across the United States. Each president of the regional banks has an opportunity to sit on the board. They rotate every 2 years. The only Federal Reserve president that actually sits on the board continuously is the New York Federal Reserve Bank president. Missouri is the only state that has 2 Federal Reserve banks, one in downtown St. Louis and the other in Kansas City. The main objectives of the regional member banks is that it staffs economists who provide reports on data like incomes in your area, unemployment rates, and other important statistics to determine our region productivity. And the Federal Reserve was formed as a result of the Federal Reserve Act of 1913. So here is a map of our Federal Reserve branches across the United States. So even though it seems some of these regions are pretty large, they have satellite banks or member banks that work with that bank within that region. And so St. Louis has branch offices in Memphis and in Little Rock, Arkansas. So you can see that they're spread across the United States to represent regional areas. Each one of those regional banks has an important role to share with the Board of Governors at their FOMC meetings how their particular regional area is doing economically. So how are the incomes? How is the productivity? How is unemployment, GDP? They also take a look at real estate rates and other important information such as that. So what does the Federal Reserve do then? Well, it has 3 main objectives. First is to distinguish monetary policy. So at every 6 weeks, the FOMC gathers together at the Board of Governors office and they discuss through their beige book how is the regional economies doing so they can determine how the United States is doing. And so they take a look at the unemployment rates and they take a look at prices. And so their goal is to maintain low unemployment, so an unemployment rate of 5% or below, and stable prices, meaning our inflation rate does not exceed 2% on an annual basis. In addition, they provide financial services because they are the United States central bank. So it's the bank that banks use to borrow from, as well as it's the bank that the United States government uses. In addition, their third main function is to regulate and supervise banks that are responsible or report to the Federal Reserve. So they supervise the nation's banking system to protect consumers. So how does the Federal Reserve affect the economy? Why do we hear about them and the decisions that they make? So through monetary policy, they can stimulate our economy. They do this. This is needed when our unemployment rate is rising, our gross domestic product is declining. We have 2 consecutive quarters of declining GDP, and our price levels are falling. So our economy is not doing well. And so when our economy is not doing well, the monetary policy would say to stimulate our economy, and they would choose to buy bonds. So the Federal Open Market Committee would take a look at data across the United States from their beige books, and they would determine that our economy is in a recession and that we should probably buy bonds on the open market from investors, causing interest rates to lower. This would be making our economy bigger. When interest rates lower, it gives the incentive for people to borrow because it brings down the cost of borrowing through lower interest rates, and it increases or decreases the savings rate, interest rate, which encourages people to buy versus save. When the economy needs to be slowed down because either we have high levels of inflation or we're at our goal unemployment or below our natural rate of unemployment between 4 and 5%, our Federal Open Market Committee might decide to slow down our economy because price levels are rising too high. If the FOMC votes to sell bonds on the open market from investors, this causes interest rates to rise, and they're causing our economy to slow down and get smaller. This increases interest rates, increasing the cost of borrowing, and savings interest rates would also increase and encourage people to borrow versus save. So what is an interest rate? This is the monthly effective rate paid on borrowed money or to savers at a bank. This is expressed as a percentage of the sum of money borrowed. So you can see that a 30-year mortgage rate before the Great Recession was pretty high at a 6.53% versus today it's closer to about a 4.17%. So coming out of the recession, we want to lower interest rates to encourage people to buy. You can see prior to the recession, a 5-year car loan was 7.92% versus today it's at a 4.5%. And the savings interest rates were much higher before the recession. They were 5.33%. And today they're only 0.15. This is to stimulate our economy and encourage people to purchase. So what's inflation? This is a rise in the general level of prices. So if you bought a bag of groceries for $50 in 2016 and bought that same bag of groceries in 2017 at $55, it would take a greater portion of your income to buy those same goods and services. That's inflation. Inflation affects how much your income can buy when prices change. When prices rise, you can afford less goods and services, and when prices fall, you afford more goods and services. So how does this affect you? Well, interest rates on loans can increase or decrease. This affects the cost of paying back, which is going to either increase or decrease. This affects the price that you have to pay for college loans, car loans, or even home loans. Well, how would this possibly affect your jobs? When interest rates increase or decrease, employers may have to either lay off employees or may be able to afford to hire employees. This could add or cancel projects that the employer may want to do. It may add or cancel research and development that an employer may want to do, or it might add or slow down their production, which would once again affect your employability. So in summary, the Federal Reserve was created as a central bank of the United States. Its main goal is to control inflation through its actions. And the Fed impacts the economy in many ways, such in our lives, either both directly or indirectly. Thank you so much.